now pleased to introduce our next speaker, Henson Arwood with J. Smith Lanier and Marsh and McLennan Insurance, based in Thomasville, Georgia. So I hope you all are back from your break, and I hope you're ready for a presentation on a topic that is of great interest, and I know I hear about, and many of the other North Florida Prescribed Fire Council members, steering committee members here and talk about quite a bit on our meetings. So we're pleased and excited to have Mr. Arwood join our meeting today as a representative from the insurance industry to talk about his perspectives on the past, present, and future prescribed fire insurance in the Southeast.
Well, David, thank you for the introduction. Thank you for the opportunity to speak with you all today. I know insurance has become an increasingly hot topic, so hope I can do the best to explain the trends going on. And, I've had the very fortunate experience of getting to work with a few of you throughout the course of my career here at J. Smith Lanier, learning about what you do, your profession, and have a lot of respect for what you do. So I do appreciate the opportunity to speak with you. As David said, my name is Henson Arwood. I'm a commercial property and casualty insurance agent with J. Smith Lanier, part of Marsh & McLennan. Now, I mentioned the Marsh & McLennan part because I know we're going to share my email address later. It does say Marsh at the end of it, so that is the correct one. And please, if you have any questions or any ideas or thoughts or advice that you may have, please share it anytime. Call me, email me. I think until we are able to put our heads together and find an appropriate solution and pull on the right ears, I think nothing's really going to change until we do that. So please feel free to call or email me at any time. A little backstory: I've been in the insurance industry for 6 years. I know that doesn't sound like a very long time and kind of green into it, but have been within J. Smith Lanier for 3.5. Came in with a heavy interest in agribusiness. Write a lot of the plantations and farms, larger farms within South Georgia, North Florida. But have a very standing relationship with a lot of foresters and write a lot of forestry industry business within this area as well. Throughout this topic, I really just wanted to talk about the market standards that we see right now, the trends from insurance as a whole, and then move into the forestry industry and how it applies to that. So to jump into it, for the past 2.5 years, we've been in what you would call a hard market. So in terms of placing coverage, as well as rates for said coverages, it's been increasingly difficult. The primary lines that we're seeing the issues within are your auto, your property, your umbrella, your general liability as well, but it kind of falls to the wayside a little bit. Auto, of course, pretty self-explanatory. The increase of population, the more vehicles on the road, the more chance for accidents. So your insurance costs are going up to organically find new ways of revenue to make up for those losses. I know that's an unfortunate way to say it, and insurance industry probably doesn't want me saying that, but that is the reason. On the property side, especially within Florida and Georgia with the increase of the storms, I know Brian talked about that earlier, increasing rates for property, especially in Florida, knowing that pretty much everything, whether you're in Tallahassee, Tampa, Miami, you're going to be rated as coastal. While that doesn't seem to have a lot of common sense, I think we lack that a little bit from time to time in terms of putting rates out there, but it is viewed the same. One portion of that they really don't talk about is the large loss or the catastrophic loss and how that is applied to property coverages and rate increase. Insurance is inherently monopolistic. So as an example, you have a company like an AIG who writes a lot of property in Florida, Georgia, Alabama, the continental United States. They write a lot in California. So when you see these catastrophic losses come through, especially from the wildfires out there, they're thinking, how can I organically build revenue to make up for these losses that we've had? And that is, we increase rate holistically. So everybody, doesn't matter, if you actually had these losses, we're going to associate rate to you in order to make up for it. So that is the primary reasons for those two lines of coverage increasing. Umbrella, I know a lot of you have had a lot of issues with that in terms of even finding coverage that would contain hostile fire without that exclusion. Your umbrella follows directly behind your casualty line. So your auto, your liability, your workers' compensation. As those lines of coverage increase from a premium standpoint, your umbrella therefore has to follow suit. So that is the reason it's kind of been delayed, and we're seeing those umbrella issues now, as opposed to where you see auto and property kind of peaking and starting to come back down. Umbrella is getting increasingly more difficult to place. So as you apply that moving forward in terms of the forestry industry, over the past, I would say, decade, maybe even more than that, Philadelphia Insurance has owned the pen when it comes to writing, your outdoor risks or your forestry risk. No doubt that they've done a very good job of that for, a very reasonable premium. The issue that they ran into is while they were assessing the risk that was associated with forestry, they were looking at your land mitigation, your timber planning, your timber surveying. They were looking at prescribed fire as a smaller percentage of your actual operations. And what they didn't account for is the size of loss or property loss or triggering your general liability, your bodily injury, or property damage that arises out of these larger prescribed fire claims or these losses. So, they just have completely taken a bath from a loss perspective as associated to their premium. So that being said, it leaves them without the opportunity to renew you at a higher price because it doesn't make sense for them. If you have a $50,000 to $100,000 loss and you're paying $3,500 in premium, which a lot of these policies are, they will never make that back up. So instead of being able to renew you at a higher price, they end up non-renewing you to cut your losses to prevent any further damage that they may acquire long-term. So where does that leave you? And this is the situation that we're running into, especially placing coverage elsewhere. You really have 3 to 4 markets after Philadelphia is out of the running. Now, Philly will still write some accounts, but you have to be small revenue, under 30% burning, and no losses. You have to be clean. So once you get into these other markets, and I say 3 to 4, one of them is a Lloyd's of London slip, which is a casualty facility out of London. And the reason you kind of mention them in passing is their minimum premium is $500,000. Obviously, they're pricing you out so that you won't actually place coverage. In the event that you do, they assume that that's just going to be a total pocket right there, and we'll have no losses moving forward. The other 3 options that you have are really starting at premiums of, $50,000 if you're clean, or you have, minimal losses depending on your revenue size. You move into your $125,000, and then the final one is a $250,000 minimum premium before you even look at the losses that are associated to you. It's becoming increasingly more difficult because of the nature of the losses that we are seeing, some of the larger losses that we've seen in the past, as well as what we're looking at from a California perspective. And this is what I mean when I say that the insurance industry is missing a little bit of that common sense. When you look at the techniques and the modeling that you have when you work in these areas, and the professionals that we have are taking the time and doing a good job of doing this land management, land mitigation properly, they're associating that as fire, which they see in California. Well, California, of course, different topography, different climate, maybe lack of mitigation principles prior to these issues being or arising. So you have that lack of differentiating between the two. So an insurance company sees, okay, fire in California, hundreds of millions of dollars in damages. Florida, they're lighting stuff on fire too. Well, we can't insure them either. So they're lumping everybody together in kind of the same boat, which is very unfair. Which leads us into the second portion of that, which is your gross negligence laws. And I know that's a big topic for everybody. 1999, 2000, Florida, passed gross negligence. Georgia followed right behind that. And what that really meant was, the protection of prescribed fire specialists or prescribed fire contractors going out and kind of taking away the liability off them in order to protect the state. Now, that's great and all. It's a fantastic piece of legislation passed if it actually is moved forward and can benefit the actual contractor in the meantime. And just what we have seen from a loss perspective and how that plays out is it's difficult. It's not really, it is definitely in favor of the burner, but until you get to that point of where it is, it's only detrimental to you. And the reason behind that is you see losses in multiple categories. So, let's say a fire jumps the line and you're looking at property damage of, maybe half a mile, whatever it is. Of course, I don't want to speak on that because I'm not the expert. But you're looking at high levels of property damage that could be triggering your general liability. So what the insurance company does is they take a look at you from, okay, let's say you've got $100,000 worth of potential damage. So they're going to put that potential damage on your loss runs in your reserves. Reserves are essentially unpaid claim dollars. So that shows up on your loss runs. What they do is they multiply that by either 20 to 45% to make up for any potential damages that they're not accounting for. So at that point, you're paying $3,500 in premium. You've got a $150,000 loss on your reserves. Philadelphia has non-renewed you. We now have to go out to the insurance market and find you a carrier who's willing to write you, seeing that there's this large loss claim on your loss runs. The issue is you think, okay, now here's a perfect example for gross negligence coming in and taking away that liability from the burner. The problem is the amount of time it takes for that claim to be mitigated by the state of Florida or Georgia coming in with gross negligence saying they're fine. It's going to sit on your loss runs for a number of years. So, by that time, you've already been non-renewed. You're paying increased premiums from other companies. And until that claim falls off your loss runs, you're going to have the same issues year after year because that loss is going to stay with you for 5 to 8 years. Now, let's say the insurance company, which we are really seeing this now, is, they're saying, hey, this is getting out of hand. It's a $500,000 loss. Chances are it's going to be more than that. We want to go ahead and settle. So they don't give the state an opportunity to come in and say, gross negligence law applies. We're removing the claim. Philadelphia settles, they pay that claim. Now for the next 5 to 8 years, you have a fully paid claim sitting on your loss runs that will not be removed, regardless of what the state comes in and says. And on top of that, you have what's called defense costs, which are included within your general liability or outside of your general liability limits. So any legal fees that you may incur throughout the claims process, whether it's lawyer fees, billable hours, court fees, all of that is going to be put on top of your loss reserve. But these are actual paid dollars. So whether they decide to associate that with your reserve or actually put that on your loss history, those dollars do show up. So now at that point, I don't know if you've looked at legal fees recently, but they get out of hand very quickly. And we're talking, I've seen them at worst case scenario, almost 550,000. At low end, we're looking at 75 to 100,000. Even 75 to 100 is a large claim. If from a premium standpoint, you're paying $3,500. So, and I really didn't want this to have this negative undertone to it of what we're discussing, but, really, steps have been taken in order to help mitigate some of the liability issues that a burner may have. But until they are followed through with and the steps become, I guess, a little more in haste, they're going to do nothing but still be detrimental to the individual and their operations, especially protecting the state. So from a solution perspective, coverage can be placed. We can always find it. The problem is, from a premium standpoint, it's going to be painful. And there are talks of potentially putting together some sort of captive or program specifically for individuals within the forestry industry we're strictly just writing forestry to try and to at least bring some relief to the individuals. But, until that actually happens, again, that's a slow moving process, trying to find an insurance company who's willing to take on that type of risk for these individuals. So, that's really kind of the trends that we're seeing, the tendencies that we're seeing. I guess if anybody has any questions, it will kind of help the conversation go if there's anything that you've thought of or popped up. So please have at it.
All righty. Well, thank you, Henson. Appreciate the presentation, and I am pretty sure we'll probably have some questions coming in soon. A lot to digest there and wrap our heads around, especially those of us who are not in the insurance industry. We'll see if we can get your contact information in the chat window shortly, so folks can get your email. If you want to put that in there, Mary Nell may have it.
Yes,
so we have yep, looks like it's in there now. Henson Arwood, henson.arwood@marshmma.com. Is that correct?
That's correct, yeah. And again, if you shoot me an email, I'll email you back. I'll have my email signature on there, a phone number too, if you'd rather have a conversation about it. So anything is welcome.
All right, very good. Appreciate that. We have a comment in from Ivan, and maybe you can comment on that. Ivan says, bottom line, he says, do not take any chances when burning. Have manpower and equipment on site to control your fire and CYA. We know what that means.
Absolutely. Yeah.
We have a comment in here from Tyler. Tyler says, great presentation. You mentioned the state, in quotes, declaring not gross negligence. Is this done through the courts?
So when it comes to gross negligence, your settlements are going to be done through that. So the individual and the insurance company are going to be settling with the courts. So the individuals that have sued based off of the, I guess, any property damage that they may have had arise out of a jump fire, yes, will be handled through the courts, but the insurance companies will normally settle until the state comes in and does enact gross negligence. So yes, it is technically on the state.
A comment in from David in the chat window, and David says, why not use the gross negligence statute as one's insurance?
Again, you can take that route, but at the same time, it doesn't stop anybody from suing you. And as if the state decides, hey, you don't qualify, or let's say this, because the whole part around it is you take reasonable effort to mitigate the fire if it gets out. And if, they come through and deem that you did not, you are personally liable for those claims. Now, again, how that's paid out, I have no idea. But again, yeah, I understand where you're coming from. I certainly do. Insurance is all risk transfer, what you're willing to put on your head or put on somebody else. So I don't advise it, but again, at the same time, I do understand where you're coming from.
All right, looks like we have opportunities to ask questions, Mr. Arwood. So please go ahead and type them into the chat or the Q&A. See if you can get some of your questions answered while we have an expert on the line. So, what's your thought? Just kind of, my question is, are you optimistic about short-term changes in the way things are, or do you think this is going to be a long-term issue that's going to be with us for a few years?
I mean, I'm definitely optimistic about it because I think that the right people are starting to have concern and understand that there is an issue. And I definitely think that's the first step of it. In terms of how long that will take, from a legislative process, I do think that it is going to take some political action to increase whether that legislation that's put on by gross negligence, maybe change some of the wording, whatever it is that really just increases the haste of the process getting these claims paid out. Because essentially the issue is if you can't find insurance to burn, nobody's going to allow you to burn on their property. And if you can't burn, then, the state gets overrun. So it is an issue. It is something that needs to be addressed. But again, I am very optimistic. Timing wise, that's a hard thing to put into perspective. So I'm sorry for not being able to answer that.
Here's another question from David in the chat window. And he says, has anyone tested the statute by fighting a lawsuit rather than settling?
Absolutely. I think so. From personal experience, I've had a couple clients who unfortunately it has settled because the process took so long, and eventually it will fall back on the insurance company to decide how long they're going to let it go. But once that happens, I really don't know, further on down the line, let's say the insurance company does settle, at what point could the state potentially step in and say, after reviewing the case, we deemed that, you weren't at fault or gross negligence wasn't present. What that process looks like, if the actual process has gone through, will the insurance company be paid back? Will the loss claims be taken off your loss runs? It's very interesting. So I don't exactly know that either.
Got some more interesting questions coming in. So this is fun. David asked, how could you talk about premiums? How much have premiums gone up compared to, say, 3 years ago?
This is what I really wanted to try and do. And the whole good thing about being with Marsh is we have this whole data analytics ability to take a look at, premium dollars associated with losses. Unfortunately, we are the only office besides maybe one or two others that specialize within forestry. So that data is a little behind. If you're looking at from 3 to 4 years ago, we had a number of policies that were written kind of like I said at that 3,500 to 10,000 in premium, which are non-auditable policies. That doesn't matter if, your revenue spikes at any point during that year and you go from, 100,000 in sales to $1 million in sales, you're still paying that 3,500 and that'll be addressed at renewal. So, when you're looking at a percentage increase, you're going from, the most I've ever seen, up until the last 2 years was 45,000. And that was a bigger outfit, multiple burners, multiple states. A large percentage of that was burning. And now, our largest is paying almost 250,000 in premium. So, you're looking at, 300 to 400% increase.
That's just hard to wrap your head around.
It's very unfortunate, to be honest with you.
We've got some couple of questions coming in on chat and one Q&A, and appreciate putting that in the Q&A, Doug. But I'm going to do these a little bit out of order, I think. One from Phil, and hey Phil, it's good to see you on there. If you have an umbrella policy, says Phil, and have never checked into controlled burn coverage before, should they do that? Should he do that before their next burn?
Absolutely. So what you're going to find is the actual wording for that exclusion is hostile fire. So under your underlying insurance for your general liability, if let's just say you're written through Philadelphia, prescribed fire or hostile fire is included under those coverages. When you get over to your umbrella, we have seen in the past that it is specifically excluded from your umbrella policy, or hostile fire is excluded. So, if you exhaust your policy limits, when you look at your general liability limits, you have $1 million per occurrence. That's so any one incident that occurs, you have $1 million to pull from. Throughout your entire policy term, you have $2 million. And, we're seeing claims at any one time, exceeding the million to $1.5 million in losses. So it's definitely something to look into. You can potentially have that exclusion removed, or chances are they won't remove it. And, again, going back to it, finding coverage from an umbrella perspective has gotten a lot harder. It's increasingly more difficult to do from a forestry perspective because of the nature of your business. And more than welcome to look at any policy form too. I kind of actually enjoy doing that. I'm not sure why. So any questions with it, feel free to send it over, and I can go through it and at least advise you on how to proceed.
And would that advice apply to if someone who was a private landowner burning on their own land, not necessarily from a commercial perspective?
So mostly what we do is going to be commercial operations. So backtracking on that, it's spoken about riding a good bit of the farms out here and some of the plantations or quail plantations that do their own burning, not contracting it out. So the companies that we insure the actual plantation through do pick up the prescribed fire on the underlying insurance as well as the excess or the umbrella. So yes, it will need to apply both to a private landowner as well as a commercial entity.
So following up on that private landowner side, are the options and are the rates that you've been talking about, does that all apply to private landowners who are thinking about making sure they have coverage for burning on their own lands?
It does not, no. So, and it's a little different because a lot of the plantations that we write and larger farms down here, we do write on a commercial policy form. So it is still a commercial policy, but we're writing the individual properties on a homeowner's form that has a farm commercial policy wording within it. So, you're getting your standard homeowners coverage, but at the same time, you're still picking up your standard liability coverages and the burning on your umbrella. So it's a little bit of both. Now, if you're writing just a standard homeowners policy, not on commercial, I can't speak on that 100%. That's big time within your policy wording and will fall under your personal liability, which more than likely is not going to be excluded unless they find out you're burning and could potentially add that exclusion to it. It's all about the gray area. Yeah.
All right, we have a couple of questions here that are related to each other, and we may combine them or we may hit them separately. One is Doug asked in the Q&A, and Doug said, Western states are planning to start prescribed burning more. I think we could all say that's a good thing. Is there a route to getting the government to underwrite liability policies for prescribed burners to take the risk off the burner?
So we haven't seen that yet. And that's kind of what I mean when I'm saying, finding either some sort of captive entity that's willing to write specifically forestry operations from a total state level, not just Florida and Georgia. I'm talking about, all of the U.S. But I do think, and this doesn't really answer the question, but I do think it is going to require participation from the government or from state government to at least fund some of the premium dollars for the individuals and maybe do everything on a per contract basis. But yes, I do think that something is going to have to come down from a political level in order to mitigate some of these premium costs for sure. Kind of what we're starting to work on now.
And I think related to that is Kevin Robertson's question in the chat. And Kevin said, would a state catastrophe fund help, including influencing the insurance company's perspectives on fire? He says there's a lot of support for this.
Absolutely. And I think right when we got on to do one of the practice sessions, I think David and Ludy, you might have been talking about it. I don't know much about it because I think they said California had a cat fund that was thinking about including the prescribed fire. I'll need to do some digging into that and kind of get a bigger understanding of what they're doing. But yes, that is, in terms of a solution wise, the more understanding that they can have from a state perspective of what goes into the prescribed fire, as well as the benefits of it, is only going to help us. And, bending the ear of those individuals are what needs to happen. Yeah. A
few more questions that are coming in the Q&A. Jacob says, are there incentives, i.e. premium reductions, for private landowners to further their prescribed fire education? So he says, I'm thinking of becoming a state certified burner or attending learn and burn events or things like that. Things like that going to influence the premiums that they might pay?
They'll want to see that you are licensed, absolutely. But from, actually reducing your premium costs, it's all about finding the market that's willing to take on that risk. And each of these markets are going to have a premium threshold that you're going to have to meet. So again, this is kind of going back to the lacking of the common sense. You're licensed, you have the training, you know what you're doing. Of course, you would think that you would have some sort of reduction in premium for that. Now, again, since you have no losses and you're just starting out, finding insurance is a lot easier. You're still looking at those low premium rates as long as your percentage of burning is under a certain level. So if you're saying, under 25% of your total operations is prescribed fire, then, chances are we still can place coverage, knowing that you're a clean account.
That's an interesting point. So the relative amount or percentage of burning that's part of the business operations is important in determining, I guess, the perception of risk from an insurance perspective.
Right, absolutely. And we're starting to see now too, where, they don't dislike all forestry operations, like we said before. So a lot of these policies are now including a hostile fire exclusion on the underlying, but are still writing you at a low premium just for the other operations that go along with forestry. And I know that doesn't really pertain to the individuals, on this call, but that is one avenue that they are going down. This doesn't help.
Yeah, here's a question from Kevin, and I've heard this from other folks a number of times. And Kevin says, is it needed to or necessary to have insurance if you work for a county agency and you're only doing, I'm guessing, fire management for that agency?
So if you're working on behalf of that agency, it depends on if you're going to be, I guess, a W-2 employee or they're going to contract you out as a 1099, because a lot of 1099s are seen as subcontracted labor. So subcontracted work is going to be picked up hopefully under your own insurance. And if not, a lot of times they're going to want you to have them added as an additional insured on who you're burning on behalf of. So it's employees of the state, yes, are going to be covered under the state insurance policy, but individual contractors who are burning on behalf of the state, so you're being paid out by contract, typically no, you're going to need to carry your own insurance in order to do that.
Here's a question from Michael in the Q&A, and Michael says, are there incentives to reduce fuels? He says, i.e. woody shrubs and trees in site prep.
So I'm trying to think of the best way to say it. And this is where the understanding of what you do comes into play for the insurance markets as well as the state. I know all of you do a fantastic job of cutting lines and taking care of the property before you burn. They don't understand any of that. They are geared centric, basically seeing that you're about to light a piece of property on fire. They're not worried about what mitigation practices you've taken into account. They're concerned about the actual fire. So, coming in and telling them that, suppression efforts have been put in place. We've got lines, we've, reduced the shrubbery around. No, they will not take that into account. They should, but they don't.
So the particulars of the individual burns or the conditions of that individual site where you might be burning are really not going to be factored into assessing the risk from an insurance perspective of the burner or their operations.
They're looking from a whole operations perspective. They're looking at, how many burns are you doing a year? Not just the individual burn itself. They're saying, we're doing 15 a year. Well, they're looking at 15 as the total, not each individual burn as it happens, because it's not a contract basis. It's written as a typical insurance account or a typical insurance policy, which has an annual effective date.
So here's a comment from Doug, and perhaps you can provide your perspective as well. Doug says, as the cost of insurance goes up, the pool of people willing to take on the risk of prescribed burning, the number of burners will go down, and as will the acres that will be getting burned. So it's a good point, Doug. What do you think, Hinson?
He's 100% right. I mean, I'm guessing that was Doug Williams, who of course has a ton of experience in this. I've had the very fortunate experience to work with Doug for a couple of years. Great guy. So he's very right. As the risk portion of this is too overwhelming for the individuals from a premium standpoint, of course they're going to go to the wayside. But that's the understanding I think that the states need to have, is as these individuals go away, your actual, chance of having a wildfire or fires get out only increases. Just because you're not lighting it on fire yourself, it doesn't mean that it's going to go away. It's just natural causes that are going to make it happen. So again, that's the political level. That's getting them to understand, because me going to an insurance company and trying to bend their ear on it, they don't care what I have to say, regardless of that we may have. But when you get it from a congressman or somebody in the state legislature or agricultural commissioner, whoever it may be, who have that stake in the game and who can have the insurance company's ear, that's who needs to be making the case. And I think it's us to make the case to the individuals who can get the insurance company's ear.
So from your perspective, is this something that transcends state boundaries? Is this kind of a South-wide issue or an issue that goes across the country, or is it particularly different or any better in other states or regions?
It's definitely I think a countrywide issue. Like we see what's happening in California and how that's spread to other states, your Colorados, your Montanas. We do a lot of business in those states as well, writing property. We are having trouble even writing homeowners policies in Montana because it's a higher risk area for wildfire. So actually it is better within the South because of the mitigation practices that have gone on up until this point, because wildfire is not as prevalent. But again, I don't know. I can't speak on like the Midwest and things like that from a burning perspective. I know that's kind of more in your wheelhouse. But I do think that it is a countrywide issue that needs to be addressed. It's just addressed from more properly in this area as it is to other places.
All right. Well, thank you so much for your time today, Henson. We
Thank you.
Really appreciate you bringing your perspective and your expertise to our forum, to our meeting.